Welcome back to this Wealth edition of Moneymakers. Now, the bond market is something which can be quite difficult to understand, but has growing relevance as companies seek to raise more capital.
Here to talk to us about the corporate bond market is Jim Stening from FIG Securities. Jim, thanks for joining us on Moneymakers.
It's a pleasure.
Now, look, you can't turn on business TV nowadays unless some expert like Nina or someone from an American channel will say, we're going into corporate bonds. And every time I hear this, I say to myself, well, how does a mum and dad investor who's sick of shares get into corporate bonds? Is it easy for them to do this?
Well, no, it's not. And actually, that's something that's really specific to this country. In other countries and other sophisticated capital markets, there's a retail bond market that's alive and well.
So the Yanks can go and buy a bond in GE if they want
Absolutely.
it.
Yeah. And in Europe, and in fact, in those countries, investors or retail investors can buy bonds issued by Australian companies.
Oh, really? So Telstra's probably selling bonds over there.
That's right.
Yeah,
that's right.
So why don't we have a corporate bond market?
Yeah, that's a good question. Really, the corporate bond market in Australia has evolved over the last decade, and it was really born out of wholesale demand, and so the structure, when credit spreads were low and debt capital was easy to get, it really suited approaching the wholesale investors rather than retail. There were some issues that needed to be, from a regulatory perspective, needed to be complied with. In the good old days of the corporate bond market, these companies could access large wads of capital on any given day.
But it seems to me that if a corporation has to go to banks to get funding, why can't they go to the average Australian who would be prepared to put $10,000, $50,000 in some of the great brand name companies of this country? Yeah,
well, I think that's going to be something that evolves out of this crisis. It really is a whole. I think these people, you know, their incomes are being eroded or they're being reduced significantly, and that does offer a solution for them, and it actually offers a solution for all of the players in that market. You
know, you sent me an email today and said, well, AMP have come up with something. So why don't you tell us about this?
Okay, well, AMP are issuing a corporate bond. It's not a simple structure. It's a subordinated debt.
You're worrying me already, mate. Once you start using words like that.
Yeah, it's interesting, but you know, they're a top quality company. It's a well-rated issue. To give you an idea, that the forecast yield will be around 7.5% to 8% in the current market. So it's actually the first cab off the rank, really. I mean, we've seen a lot of hybrid issuance in the retail space, but this is something that's moving closer to more vanilla debt.
Let me make you put the grandma test up. Would you put your grandmother into this to a small, large or medium degree?
That's always a good test.
Do you like your grandmother?
I do, very much. But look, I think with this type of asset, it really is about allocating small amounts to these types of things. Okay. I mean, they're not without risk, but just by allocating small amounts out of, if you're in cash at the moment, you know, you can pick up a yield on your whole portfolio. So you know, I think it's a question of degree, and I think you know, no one would suggest that you would take your money out of cash and plonk it into a single investment.
But the problem is when you have great brand names like AMP, people think, oh, well, AMP's there, therefore it's safe. But we have to always look at the underlying nature of the financial product, haven't we?
That's really important. I mean, obviously that's the key, because these debt ranks, you know, in the event of a wind-up of a company, you know, they don't all debt doesn't necessarily rank at the same level. Obviously, the equity holders are the first loss, but
well, most people have become scared of shares, and so they're thinking, oh, I put my money in something safe where I get a set interest rate. Now, then people start looking at these bonds, which look like fixed deposits at banks, but they're not really, are they? And I think, is there a rule of thumb that you give to recommend people when they're trying to compare, say, a bank fixed deposit, say, at 4.5%, and maybe a corporate bond at 7 or 8%? What do you say to them, Jim?
Well, I guess historically, people have used the rating agencies to make sort of that relative value assessment. Well, there's a cloud over that type of analysis, and I think also it depends what sector you're talking about. People are very comfortable with bank debt. So realistically, you need to understand the key feature of when you're investing in debt is where you rank in the event of a wind-up. So I think, you know, I'm very confident that what will evolve in Australia is senior debt issued by well-rated corporates available to retail investors, because you're right, there's a massive leap confronting these investors at the moment from cash to equities. They don't necessarily want to go there. If they can provide themselves with a better income by lending money to great Australian names and great Australian companies, well, that's a really good solution.
So the lesson might be, if someone was completely against shares and they want fixed interest, they might have a large part of their money in a bank fixed deposit. They might put something in maybe at say 5 or 6%. Some sort of longer-term fixed deposit, and you might put 10% in something like this to give you a bit more upside if they come through nicely.
That's right, and I think, look, as this whole crisis evolves and as the government's issuing more debt, that actually pushes up yields on longer-dated securities, even government debt. So we're in a situation now where you can lend money to New South Wales Treasury Corp for 10 years at 5.5%. So
you'd trust the state government, wouldn't you?
Absolutely.
Yeah, without a doubt. One last question. You mentioned hybrids. This is a way for mums and dads to get into big-name companies, but what do they need to know about hybrids?
Well, I think really they've got to understand that these are high-risk structures or high-risk investments.
Yeah.
Obviously, the banks issue a lot of hybrids, and you know, of all the hybrids, they are the least risky.
Yeah, that's right.
So I think, you know, realistically, the last thing that you want as a fixed income investor is to have all of your fixed income allocation invested in hybrids. Really, it's a question of allocating small parcels and diversifying into those assets. And as senior debt and other opportunities roll on over the next 6 months, just take parcels or smaller investments in those.
And get advice. Don't just go in and just say, I know that brand name, they can't go broke, therefore the money's safe.
Yeah, look, I think,
dangerous.
Yeah. I mean, one of the current episodes really taught us, if you don't understand it, you know, you look on, or at least seek some advice, definitely.
Now, Jim, if people want to know more about your unusual company, FIG, it sounds as though you're a fruit company. What's it actually stand for?
Fixed Income Investment Group.
Okay, so if people want to find that's okay. I've always wondered, where you're in the fruit profitable game.
We say just ask me.
Okay, fantastic, mate. Thanks for joining us on Money Makers, and we'll get you back again.
Thanks, Peter.
Cheers, mate.
Well, I wasn't an expert in corporate bonds before, but I know more about them now, that's for sure.